Hello traders, hope you are well. Absolutely baking here in the UAE, but still grinding it out every day in the market, institutional style. And that's what we're going to discuss today. I'll show you a live trade as always, but first, this week has been one of the most eagerly anticipated in a very long time because we had inflation and FOMC on the same day. Too many people in retail trading seem to be focused on things that have nothing to do with financial markets, whereas FOMC and inflation does, big time. So if you're serious about your trading, join me as I give probably the most professional breakdown of these numbers that you'll ever see and then show you how I traded it. Okay, so as discussed in the intro, we're going to be talking about this week's data. Absolutely huge week, double header, with CPI and FOMC on the same day. We're going to break it down, and then again I'm going to show you a live trade. We're going to have a look in this more professional format, so well done for being here. Obviously shows you're very serious about your trading, and this is really all that matters. Forget about all the noise. You want to get down to the important stuff, because this is what the market is really reacting to, right? So best place to start really is kind of the thing that as a retail trader you're probably familiar with. You go on Forex Factory or one of your usual data calendars, and it will show you, this week we had CPI and FOMC on the same day, but really what else does it tell you? Nothing, right? It tells you the data, but it really doesn't tell you anything about it. You need to do some digging. We're going to do that together. So what it does tell us is obviously what the number was. So you can see here it was 0.2% on the core, right? Very important number for the market because it excludes food and energy, which tend to be very volatile components, and the FOMC prefers to look at that core measure. And then we've got the FOMC data itself, and we can see that the market or the FOMC held interest rate steady at 5.5%, no change. But again, what else does it tell us? Nothing. Okay, so we need to do some digging. Now, what I will tell you is that this is actually 0.16%. Important to look at it to an extra decimal place, because we've had 0.2% readings in the past, but when we go to 2 decimal places, it's actually the lowest reading in 3 years. Okay, that's why the market took it so positively. The lowest reading in 3 years. Do you see, it doesn't tell you that here. You need to go and find that information out for yourself. That's why you get paid as a trader, to do some digging, to do some work, right, to put it bluntly. You can see here previously it was 0.3. We have had some quite punchy readings in the last 2 to 3 months, even though inflation has been falling. So the market was happy that it looks like we're now continuing to see that fall. But again, really this doesn't tell you much more than that, so we have to do some digging. So let's do that together. So as I hinted, it's the lowest reading in around 3 years. So it is worth looking at some history. You can see if we go back a little bit further that even though we had this kind of drop off in the middle of last year, which is why the market was rallying so much in 2023, it's kind of stalled. Inflation, the month-on-month readings have been kind of a little bit punchier, I should say, than the market would like and the Fed would like. That's why they haven't been so quick to cut rates or commit to cutting rates. Whereas this time, can you see it's really dropped off the last reading on a month-to-month basis? We can also see it in graphical format that, it was starting to get a little bit sticky, but it is now starting to fall off. Okay, so relative to the past, we can see it's actually a very positive number in the sense that it is starting to come off again. Now, finally, and this is the last thing, don't worry, we're not going to get too heavy. It's actually worth looking at the breakdown. You can see why professional traders do so well in trading compared to retail traders. I don't see any retail traders looking at this. This is the normal type of thing a trader in somewhere like an investment bank would be looking at. They obviously take this very seriously. It's their day job. They want to do well, so they're happy to do the extra kind of digging that needs to be done. It's actually very straightforward. You don't necessarily need to kind of focus on this too much. However, what it does help us to see is, where is this drop off coming from? So, we can see that the inflation data has dropped off quite a lot. Again, that's why the market rallied, and we'll have a look at that in a moment. But where has this drop-off come from? Which areas within the inflation basket are really causing this drop off. And my understanding is from doing research this week is that the market rallied so much because it liked that it was so broad based. Okay, and we'll look at that in a moment. It was very broad based. Okay, and the reason it's good that it's broad based is because then it's sustainable. You know, if it was just one item in the basket that caused the whole drop off, that could reverse, right? Obviously, with it being broad based, it shows that inflation is dropping generally across the board, and we can see that here. You know, you'll see a whole host of things. I mean, it is particularly services, which is good because that's been quite sticky recently. So firstly, the fact that it was coming from services was good, but even in the basket of services, we can see, if we look here, the month-on-month changes, we can see really it was across the board. So, you know, household operations, things like domestic services coming down, gardening and lawn care still a little bit punchy, but moving, storage and freight quite flat. Transportation services, which is quite a big part of the basket, you can see leased cars and trucks cheaper, public transport cheaper. Can you see it's all across the board? Photo services, video and audio service. Don't ask me, you know, specifics about what these are, but in general, video and audio services. Some of these things have stayed quite punchy. Tuition, school fees still quite expensive, but in general, can you see, very broad based, and that's why the market took this number very, very positively. So, you know, as a trader, something that you might want to consider the next time CPI is released, just have a quick look at this sort of data, or I will do it for you. We can do it kind of together. And just finally worth looking at, just in summary, you know, on a year-on-year basis, because we did focus on the individual months, on a year-on-year basis, is inflation falling? Yes, it is. You know, everyone knows about this 2%, 3% number everyone goes on about. That's inflation as a whole year. And we can see that it is starting to, you know, after just stalling a little bit, you can see it's now starting to fall off again. Again, another reason why the market took it so positively. And just finally, so we've talked a lot about inflation. What does this actually mean? What does it mean in terms of not only markets, but in terms of the interest rate kind of direction going forward? And it's very clear what it means. It means that it's likely interest rates will be cut at some stage. You know, the FOMC has been quite restrictive in terms of policy, in terms of having high rates. It's now able to perhaps turn course and bring those interest rates back down again, because inflation is now falling back down towards its 2% target. And one of the key evidences of that happening is that we're already starting to see that around the world. You know, European Central Bank has just cut rates for the first time in this cycle. Bank of Canada just cut rates. So, you know, it's likely that the Federal Reserve will at some stage seriously consider cutting rates. I think it will be later this year. It won't be anytime soon, because it does seem they want to err on the cautious side. That's why, you know, some of these other central banks have gone first. I think part of that is the Federal Reserve doesn't want to make the same mistakes it's made in the past, where it's cut rates too early and then obviously that's been deemed a mistake. So they want to show that, you know, they're very much on top of inflation. So, but we're getting there, and that's the point, and the market has taken that very, very positively, and the evidence of that is in how the market reacted this week, and really that's all that matters, right? So you can see that when the CPI number was released, you can see that the market had a big, big rally. Okay, so it was taken very, very positively. Okay, so the CPI reaction was extremely positive and the market rallied. Okay, and really that's the biggest clue you need, that the market perceived this, not only perceived it, but that it was a positive number. Okay, so that's inflation covered. We took a few minutes. We're just going to quickly talk about FOMC as I promised at the start, and then we're going to have a look at a live trade. Now the FOMC, funnily enough, it was on the same day, but it wasn't as bullish as many expected. In fact, if anything, it was the opposite, right? The Fed came out and they actually said, we're not going to be cutting 3 times this year as we previously suggested we would, in terms of, you know, they take a vote as a committee and then that vote is published, right, in terms of something called a dot plot. And we can actually see what they suggested is that they're only going to cut once. They only see themselves cutting once this year. So actually it was quite an aggressive Fed, right? They actually reversed a lot of what they've been forecasting themselves, and they're suggesting actually we think we're only going to cut once this year. So actually it was potentially a reason for the market to sell off, but it didn't. The market still took it positively. And I think one of the reasons for that is, firstly, this is why it's important to recognize that the inflation number and the FOMC was on the same day, because what it meant is we'd just come off the back of inflation number, we had FOMC, but the space between the two data releases was so small, the positive kind of effect of inflation was still there. So it didn't matter that the FOMC weren't particularly bullish about interest rates being cut. The market shrugged it off and said, well, whatever, we've just had a great inflation reading, we're happy with that. There's also a deeper reason, okay? The other reason is, if you actually look at GDP growth, right, it's positive, okay? And ultimately, I've been thinking about this before I put this together. Yes, I'm going to show you a different way of depicting what I was talking about. You can see here that the market has, expectations of rate cuts have come down. So at the start it was, the market was expecting 6 rate cuts. We're now expecting 1 to 2. Okay, so much less, but yet the market has still rallied. The Fed was saying potentially we're going to do 3 this year. Now they're saying 1, yet the market has still rallied. Why is that? 2 reasons, okay? One is, ultimately, yes, it matters where interest rates are, but what's the one thing that's more important? Is the economy growing or not? Even if interest rates are high, if the economy is growing, it's great, right? And is the economy growing? Yes, it is. So despite the Fed having rates at 5% right now, the economy is doing okay. Okay, so that's number one. And then number 2 is the jobs market is still adding jobs, right? And that's crucial. It is still adding jobs at a very significant rate, which is this. So you can see payroll still very, very positive. So economy is growing, jobs are being added, and inflation's coming down. Market's going to rally, okay, which it did. So very, very bullish on things right now. That's my opinion. I'd suggest, obviously, you can come to your own opinion as well. Hopefully that was useful for you. We can now have a look at a live trade. Okay, so this is a real trade that I took coming off the back of the FOMC and inflation data. You can see how, or you're going to see how I dealt with these pieces of information, which we just broke down ourselves in real time. It's my live account. So really, you're going to see how I dealt with it on my own account, trying to monetize this information. And you might be surprised actually with how I dealt with it. I think it was dealt with in the correct way, but probably not in the way that many would expect. So let me just show you what I mean by that. So anyway, we come into the market. I didn't trade the day of the news. Obviously, a lot of data on that day. You want the market to be able to digest it. I let it digest. I came in the next day. And the first thing to really note, right, so this is the previous day, the day of the data, is we've opened up within the same space as the previous day. So the market's traded a lot. And this is one of the advantages of using kind of professional tools like a profile, which kind of just depicts the day in a very condensed format. Like I don't want to look at the previous day in a big graphical format like a typical retail trader does, because it's just a lot of noise. I want to see, where did kind of the main chunk of trading take place in a particular day. We can see it here. It took place in this region, right? Particularly this kind of area here. Look at where we've opened, right? So we've opened up kind of bang in the middle of it. And what's that telling me? That's telling me that the market is quite happy to continue trading in the same area that it was trading in the previous day. Okay, and that's really important information, because what it's actually telling me is maybe the market's not ready to quite make a move yet, right? So to make money, the market's got to move. It doesn't appear as if the market's quite ready to move. You can even see it here where you actually look at the volume coming into that open period. There's really no edge, right? The market's happy, and there's nothing wrong with that. If the market's happy, why do you want to force a trade? Okay, so I think one of the key skills that are particularly underestimated by retail traders, I must say, is doing nothing. When to do nothing. You know, when it's quite clear the market isn't really giving you any clues that it wants to go anywhere, you know, no reason to get involved. So I recognize that we're in the middle of nowhere, and probably now's not the right time to trade. You know, it's not like the market has come down and tested an area and said, no, I don't want to be here, I want to go back to the other side. It just hasn't done that, right? It just hasn't. It's really doing nothing right now. So I've got no particular edge, okay? So I'm waiting for the market to give me a clue that it wants to get out of this area, or it wants to make a move, and that simply isn't there, okay? So that's why I said it might be a surprise to you how I dealt with this. I did nothing, okay? And I'm gonna show you why that is absolutely crucial, that you learn when to do nothing, okay? And let me show you why that is. If I actually show you my P&L, and this is the last thing we're going to look at over the last, let me just refresh it, and let's have a look at the last 30 days. Okay, I will show you in literally number format why it's absolutely crucial you learn this, because let's say I had got involved in the market, you know, I wanted to buy the market. Obviously we've seen it's very, very bullish, and market goes nowhere, right? Or even the market falls off, which it did. Funnily enough, it did sell off. And let's say I ended up losing money on a day when really there was no need to trade. So my equity curve is here. It's going to probably end up down here. Would you agree? If I come in the next day and the setup is actually there that I want and I make money, okay, so my equity curve goes back up, where have I ended up at the same point that I was before? If the fact I didn't take this trade and the next time I have a setup I do actually want to take and I get this positive result, my equity curve is going to end up here. Can you see the difference? I'll even put it in a different color. You know, in scenario one where I took this trade and I didn't want to, and then I got that positive trade, we end up with this equity curve. In the other scenario where I did what I did in this instance, and the next time I do have an opportunity, I only take that trade. Do you see the difference? Completely different, okay? So totally underestimated. As far as I'm concerned, this was a winning day. Hopefully you got a lot out of that. You know, if you really want to learn how to do things professionally, check out this video. I can't wait to see you next time.